this Rising Giants PMS webinar. It's our launch webinar of the PMS. More than happy to bring yet another product to you. Some of you might be aware of Rising Giant strategy, given that it has been in existence in the AIF format for the last 4 months. We've now decided to bring the same strategy in a PMS format. So I'll request our CIO and founder Saurabh Mukherjea to set the scene for Rising Giants, why we're doing Rising Giants. And then I'm also joined by the fund manager of the strategy, Ashvin Shetty. He'll take you through the whole investment philosophy and the stock selection process. Over to you, Saurabh.
Thanks, Pramod. Thank you, and good evening, everybody. Good to see so many of you logging into the first ever Rising Giants webinar from a PMS construct perspective. I'll set the scene. I'll set the scene both in terms of where this offering fits into the broader context of Marcellus's offerings, and also why did we bring a mid-cap product like Rising Giants to the market. And then I'll hand over to Ashwin to take you through the portfolio construction process. I think Ashwin's also going to take you through some of the stocks which are in the portfolio. So Ashwin, can we move forward? So folks, just to sort of set the context, as many of you know, and I'm sure many of you are clients, CCP, Consistent Compounders, is the flagship product. We now run the best part of 8,000 crores in CCP. It's 3 years old, and the typical market cap of a CCP stock is around $20 to $23 billion. Little Champs is our small cap product. We launched it 2.5 years ago. We stopped taking money around 16 months ago. Little Champs, the typical market cap of a stock is around $500 million. So CCP, $22 billion market cap, typical stock. Little Champs, typical stock is $500 million. When we stopped taking flows in Little Champs, which was July last year, July 2020, the sales team pointed out that there was an obvious gap, that we didn't have a mid-cap product. So the research team and the fund managers went away. We spent a year constructing Rising Giants. In August, we launched it as an AIF, and today we are launching it as a PMS. The typical Rising Giants company's market cap will be around $3 billion. So CCP, 22 billion, large cap by and large. Little Champs small cap portfolio, average market cap $500 million. Rising Giants sits in between these two products, and typical market cap is around $3 billion, right? The smallest Rising Giant stock will be around $500 million. The largest stock will be around 10 billion. Rising Giants spans $500 million to 10 billion. Now, what's common to all of these portfolios and what's allowing us to make money in all of our portfolios, Ashwin, can we go forward? Is the networking of the country. So if you sort of think about all our products, all of them are to a greater or lesser extent benefiting from 3 features which we have tried to summarize on this slide. The first is the networking of the country, right? In the last decade or so, the road network has doubled, a number of bank accounts opened has tripled, local airline traffic has pentupled, broadband connectivity is up 50-fold. You've had UPI coming in, you've had GST coming in. As you join the country up, you destroy the local or the regional player. You hand over those markets, those industries go to large, well-run, muscular monopolies. And those of you who are CCP clients are seeing this play out in your portfolio year after year, as Titan or Asian Paints or a Pidilite grinds the competition into dust, right? So that's the first dynamic. The second dynamic, and this is particularly relevant for Rising Giants, is the rise of low-cost world-class technology. We as Indians didn't create the low-cost world-class technology, but what the hell, we are massive beneficiaries of this. What this is allowing small firms like ours to do is to use, let's take an example. We are using Salesforce. My colleague Pramod, the entire sales team, the entire operations team is on a Salesforce platform. And although we have, say, 20 licenses to Bajaj Finance's 2,000 licenses, Bajaj Finance is, I think, the largest user of Salesforce in the country. Fundamentally, the same CRM platform that is powering a market leader like Bajaj Finance is also benefiting Marcellus. So a low-cost, world-class platform is available to a small company like ours. A decade back, 10 to 15 years ago, this was not possible. We would have had to hire a systems integrator, TCS, or an Accenture, pay them, $10, $15 million to install a boxed software on our server, and it was an enormously costly process. The rise of low-cost, world-class software available as SaaS, used on mobile, stored on the cloud means small, well-run companies can grow much faster, much earlier in their existence than was hitherto possible. And this has become a very powerful feature of the rising giant stock. We'll discuss a case study in a minute. And the third force, which we have not given here, because it's a little bit sensitive because of the origins of the third force. The third force is the attack on black money. And that's helping us and our clients in two different ways. Firstly, the attack on black money cripples the competitors to our investee companies. So just to sort of go back to, say, taking a simple example, if Titan is in our portfolio, the typical local jeweler for a long time benefited from both tax evasion and from the use of gold as a laundering asset, right? Gold as a laundering asset was a well-known thing. And the typical jeweler benefited from both of these, right? The inability of the local jeweler to evade taxes lowers his return on equity, and the fact that the government has taken step after step to reduce the ability of jewelers to launder gold hits the jeweler's top line. So the tax evasion hits the PAT number, so to speak. The inability to use gold, it's still not gone away entirely, but the variety of measures implemented in the last 6 years make it much harder for jewelers to launder. And that means the local jeweler's ability to compete with Titan is therefore compromised, and we benefit as Titan shareholders, right? And if you think of it at a bigger picture level, the sort of multiple assaults on real estate and gold that have been mounted by the incumbent dispensation in Delhi has played a critical role in pushing money into the financial system, which has driven down the cost of capital. The 10-year bond deal 15 years ago was 16%. 16 years ago, the 10-year bond deal was 16%. Today, it's 6%. That drop in the cost of capital disproportionately helps well-run companies of the sort that sit in CCP or rising giants or LCP. It hurts smaller players who don't have access to a modern financial system, right? So the entire construct behind us, right, whilst you would love to take credit for our returns, but what's also true is the entire macro construct in which we are operating, the networking of the nation, the rise of low-cost world-class technology, the crackdown on black money, it's playing beautifully into the Marcellus investment philosophy. Now let's just show you some of this in action so that you can visualize it and also contextualize rising giants. Ashvin, let's just do this slide. So what we have shown here, and this is a familiar slide, we have given you a bunch of our investee companies across our various portfolios, right? And just to sort of give the layout of the slide, the left panel is free cash flows. Free cash flows is what discerning fund managers focus on. This is the surplus that a company generates after everybody has been paid off. So not just, this is profits, less working capital load, less capex. So free cash flow is the surplus that a company generates at the end of the year. So that's the left panel. The right panel is the share price. The share releasing free cash flow compounding and share price compounded over is in lockstep. The time horizons are the last 20 years, the last 10 years, the 10 years prior, the last 5 years, the 5 years prior. So both panels have the same time horizons. So if you look at the weighted average row, what you'll notice is the sorts of companies we invest in pretty much compound pretty consistently at 25%, whether it's the last 20 years, last 10 years, the 10 years prior, the latest 5 years. A typical Marcellus investee company guns out 25% free cash flow compounding, and that allows it to grow your wealth at 25%, right? This is familiar territory. You would have heard us say this before. Now, where it gets very interesting is if you look at the names in that table. Right, the top part of the table are companies that at the turn of the century, they were already market leaders. So for example, at the turn of the century, Asian Paints had been a market leader already for 30 years, right? And it's to the company's credit that in spite of being a market leader in the year 2000, Asian Paints is still compounded at 24% in terms of free cash flow since then, right? Which means 100x growth in Asian Paints' free cash flow compounding. Similarly with, say, a Pidilite. So the names at the top part of the table were companies that were already built out market leaders at the turn of the century, and you're getting 25% cash flow and share price compounding from them. And those of you who are CCP clients are benefiting from this. But if you see the lower part of this table, right? The last 3 rows, these are the sorts of companies that are rising giants companies. Market cap of $3, $4, $5 billion, typical rising giants territory. Now, what you'll notice is if you look at the 10-year cash flow compounding of these companies, remember these companies, a Page, a Relaxo, a Dr. Lal, they were barely sort of, in existence at the turn of the century. They were smidgen companies, really tiny companies at the turn of the century. So the rising giants companies, and these three are symptomatic, they have been born in the era of economic consolidation in India. They've been born in the era of low-cost, world-class tech. And therefore, to a far greater extent than is possible with the larger names, technology and the use of technology to drive rapid compounding is central to the success of the rising giants companies, right? So if you see their free cash flow compounding, say that, look at the FY 11 to 21 column, look at Page, Relaxo, Dr. Lal, you'll notice that the free cash flow compounding of these sorts of firms is closer to 35 than to 25. And that extra 10 percentage points, the faster free cash flow compounding, is driven by more aggressive use of technology to drive growth. So just to use a simple case study that you might have heard from us before, but a case study which remains very, very relevant in the context of what's happening in the country. Look at Dr. Lal Path Labs, right? So Dr. Lal himself ran this business till 10, 11 years ago when Om Manchanda, the current CEO, took charge. Om is ex-IIM Ahmedabad, ex-Unilever. What Om has done is over the last decade, taken a business which was generating, say, 25% ROCE a decade back and made it a business which generates 125% return on invested capital. He's made it a cash machine, right? And central to making it a cash machine is the use of technology to drive higher profit margins, the use of technology to crush the working capital cycle, the use of technology to improve the sweating of the fixed assets there being the lab infrastructure. Om has used technology very cleverly to sweat the lab infrastructure much harder than it hitherto used to do. And by using technology cleverly, he's created a paradigm where it's very difficult for anybody else, whether they're organized or unorganized, in the north or in the south, it's very difficult for any other path lab to go head-to-head, toe-to-toe with Dr. Lal Path Lab because the cash engine here fires so powerfully. So just to give an example, if you look at working capital cycles, right, this is obviously a big deal for a path lab. Remember, Dr. Lal Path Lab, a decade back, barely had, I think, 100, 200 testing centers. They now have the best part of 6,000 testing centers. A decade back, they were offering basic products like blood tests and urine tests. Today, they offer 5,000 tests. Out of those 5,000, there are 2,000 tests which no other path lab offers, high margin, high EBITDA margin tests, no other path lab offers. So even if you go to large hospitals, say I live in a suburb of Bombay, the local hospital I use outsources almost all of the high-end tests to Dr. Lal. I'm sure wherever you live in India, it's a similar story, right? Now, what that creates is it creates a working capital challenge for any path lab. In any business, there are 3 layers of working capital one thinks about. First is called receivables, which is how much later from the point of purchase does a customer pay you. For obvious reasons, in a path lab, there is no receivable days. You typically pay at the point of use of the product. Where a path lab gets stuck is inventory days. Dr. Lal is offering 5,000 tests. For a typical test, you need 3 or 4 inputs. So therefore, Dr. Lal, in any given test center, has to run an inventory of 20,000 items. And remember, they're doing this across 5,000 centers. That's a Herculean inventory management exercise. Most other listed path labs have a working capital cycle due to inventory days of 10 to 20 days. Dr. Lal Path Lab has a working capital cycle of 0 days. India's largest path lab, with the most amount of test centers, with the greatest number of tests offered, has a 0-day working capital cycle. So how did they pull this off? Everybody uses SAP. Dr. Lal uses SAP. So the use of technology per se is not the only factor. What Dr. Lal does, which is very novel, is they use their software to track how many units of, say, the urine test ka plastic dabba. How many do I need in Kurukshetra? How many do I need in Lajpat Nagar? How many do I need in Meerut, etc.? Then they consolidate that demand because they can see on their tracking systems how many do they need. And then they negotiate with the supplier for a corresponding number of creditor days. They tell the supplier, I will pay you X number of days later. Given that I'm the largest buyer, I'm bringing you a lot of business. The supplier usually agrees. And they offset the inventory days with the creditor days. They offset the inventory days with the credit that the supplier gives them. The 2 numbers cancel out. And hey, presto, you have India's largest path lab operating on a zero working capital cycle. We could discuss several such applications of technology with Dr. Lal. We could discuss this in the context of Relaxo. We could discuss this in the context of Page Industries. All of these companies are gunning out rapid free cash flow compounding faster than competitors on the back of the smart use of technology, right? This, in a way, becomes a distinguishing factor, because if you have more cash, you use that cash to muscle into competitors' territory. Those of you who live in Mumbai would have seen, right? A month back, Dr. Lal acquired the second largest path lab in Mumbai, right? And this is a classic Dr. Lal deal. Go to a territory, talk to the second largest player, tell them that, look, you have a choice. You compete with us and you know what will happen. Or here's a cash payment. It pays for your retirement corpus. You, the erstwhile owner of the regional franchise, will become the regional manager. Your brand name will remain. Our super efficient, the Dr. Lal super efficient brand name, the back end will kick in. And by using our superior free cash flows, we, Dr. Lal, are consolidating the path lab industry. And you and I get the benefit of that. Remember, 85% of the path industry is mom and pop labs. Just 15% is national chains, of which Dr. Lal is the largest. So think about the compounding runway. You're investing here with a clean management team, clean promoter, smart management team, consistent use of technology and capital to crush the competition, and an enormous growth runway. This is a $10 billion industry with 85% in mom and pop. Imagine the growth runway you and I have as we compound in the rising giants over the next decade or so. So that is the construct, that's the inherent sort of idea behind creating a portfolio of 15 such companies. How did we build it? I'll request my colleague Ashvin Shetty to elaborate.
Yeah, thanks, Saurabh. Good evening, ladies and gentlemen. Hope all of you are doing well. So let me change the slide. Yeah. So as Saurabh said, Rising Giants, we have already launched it in the AIF version. It is now around 4 months old, and we have raised close to 352 crores. That money is well put into use. Currently, the model portfolio allocation for stands at around 99%. We have 1% allocation to cash. The investment philosophy which Saurabh explained, so we are essentially looking for 3 attributes in any stock to make it to the portfolio. First and foremost, it should be a clean company, that goes without saying. The company is strong, but if it is not clean, nothing will accrue to the minority shareholders like us. And secondly, we continue to prefer dominant companies, market leaders, and preferably dominant companies. That is where the pricing power comes in. That is where the gap between ROC and cost of capital comes in. And that is where the free cash flow generation ability of the companies come in. And thirdly, the company should have a very effective capital allocation track record. So the core business would be throwing a lot of cash, but if the company is at the either end of the extreme, either it is too lazy and that cash is just accumulating on the balance sheet, it will not generate any return. That company will not generate any returns for us. Secondly, if the company is super aggressive and it is investing in a completely unrelated business, there also the ROC will eventually crumble, and hence it doesn't make sense. So what we are looking is, the Saurabh gave the example of Dr. Lal Path Labs. The company should ideally be reinvesting back that cash into increasing its market share. Either it is in the products, either it in technology, or going the distribution network, or where, suppose the company has already reached a very high level of market share, it should target the adjacencies, grow into adjacent product segments, which has a relationship with your core business. Or you grow from one market to another, preferably grow from one state to a pan-India presence, or ideally go from India to a global business. So we want companies which are effectively making effective use of the cash that is thrown by the core businesses. Where the difference comes is in the Rising Giants universe. So here we are targeting a market cap universe of $500 million to $10 billion. In other words, 3,500 crore to 75,000 crore market cap range. And before I go to the portfolio construction, we validated the risk and return characteristics of this market cap range. Whether are we taking whether from a return and risk perspective, this space makes sense. So we had some experience of managing the companies in this market cap range in our Retail Champs and CCP portfolio. But we also, what we did is that validate it at the broader market level. So just a qualification, the mid-cap, mid-size companies here, definition means 3,500 to 75,000 crore market cap. Large cap is more than 75,000 market cap for the purpose of this slide, and less than 3,500 crore is small cap. So this is not strictly the SEBI definition. This is just internally used by us for for this slide. So from the return side, what we found interestingly is that, on the top left-hand side chart, as you can see the dark blue bar, that represent the top 25% mid-cap, the return generated by top 25% mid-cap. You'll find that across different time periods, whether we look at the 3-year calendar year CY 18 to 20 or 5-year or 10-year period, consistently the top 25% mid-caps, they have generated better returns than the top 25% large caps. So not only relative to large cap, but even on an absolute basis, you'll find that across different cycles, the top 25% mid caps, the return is touching 50%, if not more. Actually. So this kind of addresses a big concern that the top good quality mid caps, they are able to defy the typical cycles that are associated with small and mid caps. And secondly, this return is also backed by the performance at the fundamental level. So the right-hand side, top right-hand side chart will show you that across, again, the different time periods, the top 25% mid caps, they generate better, higher earnings growth compared to the top quality large caps. Here also on an absolute basis, you'll find that irrespective of the underlying macro cycles, the top quality mid caps, they generate very high absolute EPS growth. For example, even in a very challenging period of FY 18 to 20, you will find that the dark blue bar, the median EPS growth is touching 50%, even in a very tough, challenging corporate earnings period. So that helps us conclude that there is a lot of money to be made by identifying and investing in good quality mid caps. Now, what about the risk side? Are we taking too much risk by investing in this space? So here we flip the scenario. Here we build a scenario, where we end up investing in the worst quality mid caps. So how will the situation look? How will this picture look in that situation? So the bottom, both the charts represent that situation. Here also we found that the bottom 25% mid caps, the fall in earnings as well as the share price, they are significantly lower compared to that in the small cap space. So small caps may, if you end up investing in poor quality small caps, there is an absolute carnage in the returns. But that scenario is not as devastating in the case of mid caps. So mid caps may in the worst periods, or you get invested in the bottom 25% mid caps, the fall in the earnings is substantially lower compared to small caps, and even the fall in the returns during market dislocation, that is substantially lower compared to the small caps. So this makes us conclude that by identifying and investing in good quality mid caps, you can actually generate returns akin to investing in good quality small caps. But the risk in the space is significantly lower compared to the small caps, and hence the title of this slide, mid cap, top quality mid cap, the sweet spot in Indian equities. Now, having convinced ourselves about the merit of investing in this market cap space, how we go about building the portfolio is through our investment process. So I will go through it very quickly because we have covered it in numerous webinar earlier. So broadly, our investment process consists of two parts. So one is we use a couple of quant screens to help narrow down the starting universe into a very small subset. So typically across our different portfolio, our quant screen help us eliminate more than 90% of the starting universe, and Rising Giants is not an exception. So Rising Giants may, at the starting level, there are 450 companies in the market cap 0.5 to 10 billion. And the quant screen, after applying both our quant screen, we are left with 35-40 companies, which forms the universe for our bottom-up research. So the first quant screen which we apply is the forensic accounting screen, which is the second box in this flow. The forensic accounting screen is nothing but a set of 12 accounting ratios, which we use to rank companies on our accounting quality. And accounting quality is all the more important in small and mid cap space. So we rank companies using these 12 ratios. We give them a decile-based ranking, D1 being the best 10% of the universe, D10 being the worst. And we eliminate companies falling in the bottom 40%, D7 to D10, because our model is implying that there is prima facie concern surrounding the reported number of these companies. So 40% of the companies get eliminated at the forensic accounting screen. So we are typically left with 200 to 250 companies. Now our objective is to find companies with healthy ROC, but they're also reinvesting back the cash, and they are sustaining that ROC on a reinvested capital. So to find that elite list of companies, we use 4 ratios. We apply them on the last 6 years financials. So the first ratio which we use is revenue growth. We calculate what is the increase in the revenue growth over the last 6 years. And the next three ratios basically calculates the quality of that revenue growth. So what we use is improvement in the operating margin over the last 6 years, improvement in the working capital days over the last 6 years, and finally, what is the improvement in the fixed assets turnover over the last 6 years. So idea, as I said, is to find companies which are growing, but which are growing by generating enough internal accruals, and they are again reinvesting back their internal accruals. So we don't want companies which are growing, by putting their, for example, working capital to risk. And hence we select companies which score more than 50% on each of these four ratios. For example, if a company scores very high on revenue growth, but working capital mein uska score bahut kam hai, so that company wouldn't get selected. So company has to be the best 50% on each of these four ratios. And you'll be surprised to know that out of these 200, 250 companies, only 35, 40 companies actually clear this hurdle. And this 35 to 40 companies form the basis for our bottom-up research. And broadly, our bottom-up research consists of two parts. One is secondary research, which typically involves reading at least 15, 20 years of the annual reports of the company, and which helps us basically chart the evolution of the company, build conviction about the mental makeup of the promoters, how they have dealt with the crisis in the past. That gives us a lot of confidence about the business model of the company as well as the ability of the promoters. And more importantly, we rely on a lot of primary data research. Typically, we end up speaking at least 10 to 15, people in the industry. Obviously, we meet the management and get their point of view, but we place more reliance on the independent, so typically people like, customers, vendors, ex-employees, we speak to at least 10 to 15 people on each of these companies who can actually help us corroborate our understanding or give us incremental insights on the company. And this, as Saurabh said, it took us a good 12 months to build the portfolio. I think bulk of this actually time period actually went into building a credible insights to our primary data network. And after doing this, both secondary research and primary data research, we use our stock selection and longevity framework, again, which we have discussed quite a bit. So what happens after a cons in most of the companies, they have very healthy ROC, they look very good on paper. Now, the idea of the bottom-up research is to basically go deeper into the this ROC point. So our stock selection and longevity framework actually we go deeper into the moat of the company, whether it is, for example, if there is any competitor coming into the industry and dropping the prices, whether the market share of the company will drop. For example, that is one big test which we do. And more importantly, the company may be looking very good currently on the moat, but is the management lethargic? Is the management always on the toes, always tries to stay ahead of the curve, ahead of the peers? So we look at that aspect through a lethargy framework. So we look at, is the R&D, for example, the R&D engine of the company continues to fire? Is there any stagnation on that? What is the company doing about investing into technology, which is becoming all the more important in today's world, both from a front-end perspective as well as the back-end perspective? And finally, is the company adding new growth drivers? So we look at that aspects on the lethargy side. And finally, we look at the succession part, because to scale the business beyond a point, the promoters necessarily have to build a team. So we look at, whether the promoter is delegating responsibilities. What is the quality of the team? Is it the appointment to the team made basis the relationship, the relatives and friends of the promoters, or the appointment made on the qualification of the person? And what is the incentivization of the management? And most importantly, what is the quality of the independent board of directors? Because there should be somebody in the company to question the promoters, on the capital allocation decisions, on the strategic decision. The better the quality of the independent board of directors, I think that gives us more conviction. There is some check and balances within the company. So having that done this, passing this 35-40 companies on our stock selection framework, the best 15-20 companies best 15 companies, make it to the portfolio. So both the stock selection as well as the position sizing is primarily driven by our longevity framework. And this is how the portfolio currently looks. So we have 15 stocks in the portfolio. Some of the names of some of the companies have been mentioned in this slide. So I think if you look at the EPS growth column, you'll find that at the weighted average level, the portfolio has delivered 21% earnings growth over the last 5 years. Again, this has been one of the most challenging period from a corporate earnings perspective. We had GST, we had the lingering impacts of demonetization, we had pandemic towards the end of FY20. Despite this very adverse macro scenario, these companies have been able to deliver a very healthy earnings growth. And that has primarily come from two things. Either these companies have gained market share within their sector, because of the examples that Saurabh gave about investing into technology, investing in expanding the distribution network, and so on. Or secondly, they have used their capital allocation very smartly to build adjacent growth drivers, be it getting into new products or basically expanding the addressable markets. So as a result, these companies have been able to defy the macro slowdown and clock very healthy earnings growth. The free cash flow column looks even better actually. So the free cash flow growth at the portfolio level is around 24%. And this has primarily come from most of these companies are able to crush their working capital days over the last 5 years. Again, this is primarily because of few reasons. One is because of the investment in the technology. Most of the companies have been able to manage their, for example, the inventory days better. So inventory days has seen a reduction across most of the companies. Or secondly, because these companies have been gaining market share within their sector, the bargaining power of these companies have increased in the industry ecosystem. So as a result, they are able to extract better days from the vendor at the same time cut down on the credit period to the customer. So this has actually helped them bring down the working capital days, and hence the free cash flow. And mind you, this free cash flow CAGR is not at the expense of any slowdown in the reinvestment ratio. These companies continue to reinvest back very heavily into the business. So if I'm not wrong, I think the reinvestment ratio across at the portfolio level is well north of 50%. So despite this heavy reinvestment ratio, the free cash flow CAGR is ahead of the EPS growth, primarily because of the crunch in the working capital days. And finally, the last column is also very important. You'll find that most of the companies have bracket against their figures. That denotes that most of the companies have surplus cash on the balance sheet, and this places them in very advantageous situation. Most of the players in the small and mid cap space, they have seen their balance sheet actually completely erode in the last 5 years because of the situation that I mentioned. Whereas most of the rising giants companies, they have net surplus cash on their balance sheet, and this places them in a very strong position to consolidate either organically or inorganically their market share over the next 3 to 5 years. And hence we believe that the companies, the earnings growth that these companies have delivered over the last 5 years, that can very well continue in the next 3 to 5 years also. And this is how the return. This is a little bit of theoretical return. We are given a stock-wise attribution. This is since the launch of the inception of the fund in the AIF format. You'll find that most of the companies have delivered. This is the number till 30th November. Most of the companies will find that they are in the cumulatively positive return till 30th November. And at the overall weighted average level, the portfolio return is around 6.8% versus the benchmark, which is BSE 500 for this product, of 4.9%. So this kind of corroborates that the stock selection has worked so far for the funds. And finally, we'll go into a couple of case studies. So I'll take the first one, and I will request Saurabh to take the next talk. So GMFAUDLER, again, this has been one of the favorite stocks at Marcellus. You may have heard us talking about this stock earlier also. So GMFAUDLER, let me explain GMFAUDLER to our longevity framework. So GMFAUDLER, so a longevity framework has mode, lethargy, and succession. So I will discuss GMFAUDLER through that framework. So on the mode side, GMFAUDLER, as most of you will be know, has a dominant position in the glass-line equipment in Indian market. So glass-line equipment is a very critical product in the pharma and agrochemical industry. Because the processing or the reaction takes place at a very high temperature, you need to have special kind of vessels which are ceramic coated or glass coated basically in this industry. And GMFAUDLER has been a market leader at least for the last 3 decades, pretty much since the inception of the company. It has close to 50%, if not more, market share for the last 3 decades. And that market share has come from 2 to 3 things. One is that, if you look at the overall capex in the pharma and chemical space, and you'll calculate what is the ratio of GLE spend to that overall capex, it will be, I would suppose, around 5% or so. In other words, if a competitor comes and offers a very cheap product, it doesn't entail a lot of savings for the customer. But at the same time, the quality is very important. Even if there is a small crack in the vessel, basically you have to change the vessel, which means at least 2 to 3 weeks of production disruption at the customer end. Given that cost is not factor, but quality is a very big factor, and hence the propensity of customer to change reliable, quality-oriented companies very low in this space. And secondly, GMM has beyond its flatline dominant has also built a lot of new additional growth drivers over the last decade. So 10 years back, it bought a company called Mawag in Switzerland, wherein it got a technology to develop drying and filtration equipments, which is again catering to the same end user industry, pharma. So it's not catering to a completely different industry. It's catering to the pharma and chemical industry. And GMM has actually leveraged its GLE dominance to push these products to the same end user industry. And on the lethargy front, despite being a market leader, GMM has been trying to stay ahead of the curve. For example, last year there were two important developments in GMM. One is it bought the third largest Indian player called DDPS India Private Limited, wherein it got access to the very lucrative, or rather very important, South Indian pharma market. So GMM is actually, earlier the plant was based only in the Western India, but through acquisition of DDPS India, which had the plant in Hyderabad, now it has got access to the South Indian pharma market. And more importantly, it bought its parent Pfaudler stake last year. So Pfaudler, the problem with Pfaudler is that it has been changing hands among the private equity investors every 5 to 6 years. So there was always an overhang that, whenever a new private equity investor, whether there will be any sharing issues surrounding the sharing of technology with GMM Pfaudler. But last year, after GMM has bought its parent Pfaudler, now there is no more overhang. Now GMM actually owns the technology at the global level. So that big overhang regarding technology has gone away from the stock. And besides GLE, GMM continues to build its non-GLE business. It has, for example, bought Sudarshan Chemicals industry mixing systems around a year back. And more recently, it bought the heavy engineering division of HDO, Hindustan Olivers. So from a mode perspective, all tick marks. From a lethargy perspective, also all tick marks. And finally, on the succession, also, there is a recent appointment of a CEO to manage the Indian business. Furthermore, there is the company has proposed ESOP, for example, recently. And the board of directors quality of GMM Pfaudler also looks top notch. So on the succession part also tick mark. So I will request Saurabh if you can take us through the LTTS case study.
Sure. Thanks, Ashwin. Thanks. So folks, as Ashwin has explained, right, what we are doing with, say, a GMM Pfaudler, as I explained earlier in the Zoom call, what we are doing with Dr. Lal, we're looking for smaller companies. GMM Pfaudler is $1 billion. Dr. Lal is $3-4 billion. But we want them to be, just because they're small doesn't mean they should be run-of-the-mill franchises. We want them to be dominant franchises. Now, this type of company, small yet dominant, is actually quite difficult to find in the IT services industry. As many of you know, we have TCS in CCP, and TCS is the gorilla in Indian IT services. It's dominant as much because of its supply side advantages. It's got the best training and recruitment processes in Indian IT by far, and that gives TCS the lowest attrition rate, the highest operating margins, and the strongest free cash flow compounding. So we spent a couple of years trying to find a similar small cap or mid cap IT services company. Very early on, we realized that engineering R&D is one of those niche parts of IT services where you could find such companies. In a way, engineering R&D is not even IT services in the conventional sense of the word. Here, what companies like Cyient or Tata Elxsi or LTTS are providing is as much a product. They're going to a client, say they're going to a Boeing and saying, we will get your in-flight entertainment system sorted out. So it's not as if an IT service, it's not as if you're running Boeing's IT systems. You're providing to Boeing a product, or in the case of, say, a chemical engineering plant, you're providing to them a process for running the plant. And therefore, in many regards, it's the IT services, the engineering R&D companies are as much a product company as they are conventional IT services. Now, the reason engineering IT services appealed to us was there is obviously a runaway demand for these services. The large Western companies, the large Western engineering companies, the oil and gas companies, the chemical companies, they don't have enough scientists to do anything more than the core function. So if you're building a electric EV truck, if you're building an EV truck in Germany, your entire R&D team will be focused on the core EV platform. Everything else which is non-core, you'll need an engineering R&D service provider to take hold of and run with it, right? So it's a massive industry, growing at 15% dollar terms, 15% comfortably year after year. Very little disruption in that growth. It's very smooth growth. It's driven by scarcity of engineering talent in the Western world. It's driven less by cost arbitrage. It's driven more by the intense scarcity of engineering talent in the Western world. And therefore, Indian IT services companies, Indian engineering R&D companies felt like natural ways to make money from this dynamic. However, Tata Elxsi is focused on a specific aspect of engineering R&D. It's a niche play. Similarly, Ascient is focused on a specific aspect. We wanted an engineering R&D services company which allowed us to go across the waterfront, make money from aviation, make money from the transportation industry, make money from the chemical engineering industry in the Western context, make money from semiconductors, from telecoms. LTTS fitted the bill perfectly, right? It is the largest engineering R&D services company in India, one of the largest in the world. It has very high billable rates. Demand for its services have been high for the last, I think the company is 7 years old. From the time the company was created, demand has been high. So you can also see it quite easily, right? 7 or 8 year old company already worth the best part of $8 billion, right? And the numbers in that chart, also the numbers in that table also tell you the story. FY21 numbers were COVID impacted. In spite of that, the business has grown. Free cash flow has grown at 24-25%. If you take the first half numbers, this company's profits and cash flows are growing at 35%. And this is, remember, a long-term CAGR, right? And you're growing a business in dollar terms in 15% top line. Revenue terms, rupee compounding would be the high teens, and profit and free cash flow compounding, if you take the first half numbers this year, are growing at some in the high 20s, low 30s, right? Now, why is this happening? Why is LTTS able to grow engineering in a niche industry like engineering services across the waterfront? The answer lies in the supply side. Getting thousands of engineers from the IITs, the RECs is not easy, right? Because IIT and REC engineers these days in India have plenty of choices, and joining an engineering company like the old L&T, the sort of the conventional L&T, or getting into say airline entertainment system design is not the natural calling for most electrical engineers these days. What LTTS has done over the last 8 years is built a brand, built a recruitment system on campuses in India through competitions, through scholarships, through sponsorships of students. They've built a talent funnel. That talent funnel becomes a very powerful competitive advantage, because remember, after all, what are we doing here? The West has a massive shortage of engineers. We are basically taking our engineering talent and designing for the West their airline entertainment systems, their EVs. And for that, we need engineers from our own country. LTTS has built the best pipeline of engineering talent firing into the Fortune 500 companies. The client base they built is formidable. So I think in the slide here itself, Ashwin is saying that 69 out of the Fortune 500 companies are their clients. There's a different way to think about it. Out of the world's top 100 R&D spenders, the majority are LTTS clients, right? So the majority of the world's top 100 R&D spenders are LTTS clients. There's scope to grow each of those relationships. There's scope to further capture the other 50% of the top R&D spenders, which are not yet LTTS clients. Now, central to this is taking your talent base, the REC and IIT graduates we discussed, and turning it into intellectual property. So if you look at the number of patents filed, and we've tracked this steadily over the last 3 years. I remember 3 years ago, LTTS had 350 patents or 320 patents filed. Now it's north of 700. And that's a classic sign of a R&D engine, of an R&D company, which is firing. So the science quotient is high. The recruitment pipeline is strong. Effectively, you're combining science and talent and selling it to the Fortune 500. Out of the world's top 100 R&D spenders, 50 are LTTS clients. And in the space of 8 years, L&T has built, L&T, the parent, has built an $8 billion business where free cash flows are compounding at the best part of 35%. Right? So niche business, but at the same time, competitive advantages around on the supply side. TCS is $100 billion plus. This is $8 billion, but a very similar story. Competitive advantage in the tech sector in our country today is on the supply side. The demand is a given. Can you get the talent? Can you get Indian talent? In TCS's case, lakhs of engineers, and in L&T's case, thousands of engineers. Can you get them, hire them, train them, and then sell their brains, sell their talent to the Fortune 500? LTTS has done a fabulous job. So I think those are the case studies. Ashvin, back to you for concluding comments.
Ramon, you want to take this? Or?
Sure. So in terms of the specifics of the housekeeping details, I can see some of you have already asked that question. We have fee options both in the fixed fee, which is just the management fee with no performance fee, and the hybrid fee option with an element of fixed fee and performance fee. There are slab-wise, and also, of course, those who are coming direct and regular also have different fees. You can contact the sales team for the fee structure. We will put it up on the website, and some of you have received the emails as well. However, given that we first launched it in the AIF format, we want to keep both the structures very similar in terms of terms. Therefore, the AIF for other reasons is bound to have a lock-in. We have a 15-month lock-in in the AIF. Because you can't do a lock-in in a PMS structure by regulation, we've sort of created a deterrent of sorts through a 2% exit load. So that way the AIF investors won't be disadvantaged either. And again, because the minimum investment in an AIF is 1 crore from a regulatory perspective, we've stuck to 1 crore here as well. However, one option we can do in a PMS that we can't do in an AIF is you can opt for an STP, which is we can stagger your investments over 5 months. Some of you heard us time and again, we've always maintained a lump sum investing has an edge over staggered investing, but the staggered investing can help keep your nerves at times. So it's really your choice. If you ask us, we always recommend a lump sum investing. So those are the specifics. Before Ashwin, if you'd like to conclude, or should we open up the call for Q&A?
I think we can open up for Q&A.
All right. So there are some interesting questions coming in. So again, a usual question around midcaps. Midcaps have had a great run over the last 18 months or so. Several midcaps, in fact, have doubled or tripled. Does it make sense to invest in midcaps? Is it the right time? I know it's a fairly generic question, but how should we help this gentleman who's asked the question sort of?
I think the answer is on the screen, Pramod. So folks, as we showed in slide 3 of this deck, whether you take the CCP type companies or the Rising Giants portfolios in front of you, classical high quality compounders in India compound at around 25%. We've made this point, I think, in webinar after webinar, and 25% of which, if you remember Rakshit's webinar from a month ago, typically revenue compounding will be in the vicinity of 12-13, PAT compounding will be high teens, free cash flow compounding will be mid-20s. That's the classical paradigm. You can see that in the free cash flow column here. If you take these companies last 5 years, they've compounded, their share prices have compounded at a similar rate. So a lot of people somehow believe that some miracle has happened in the last 12 months. The reason they feel like that is they take the post-COVID low, and obviously if you take the post-COVID low and take it to today, you see rapid compounding. But if you go away and take the 5-year pictures of these companies, you see free cash flow compounding and share price compounding has moved pretty much in lockstep. And therefore, the notion that somehow the bus has gone on mid-cap or the bus has gone on any cap is mistaken. Not only has the bus not gone on any cap, on generally in mediocre Indian stocks, which is the vast majority of the stock market, I would say 90% of the stock market, where there is no free cash flow to talk about, let alone free cash flow compounding. On mediocre Indian stocks, the last year was a bad time to invest. Today is a bad time to invest. Next year will be a bad time to invest. If you can lock into franchises with 25% cash flow compounding consistently year after year, even if you invest today, you'll make a good return. But if you can't do that, if you don't want to, or if for some reason you can't lock into high quality compounding machines, then I would suggest don't invest today. But I would have given you the same advice a year back. So this fascination that somehow because of the extraordinary rally from the bottom of COVID, say from 21st March 2020, and therefore some extraordinary rally is now finished and we will never make money in equities, that's misguided. We take 5-year views. And as we've shown in CCP and in this portfolio, you're all right, provided you are willing to invest with us for that horizon.
Thanks, Saurabh. So I guess another oft-asked question is around the allocation. And I guess implicit in that question is what sort of returns, at what risk do we expect from Rising Giants vis-a-vis some of our other portfolios? And hence, to extrapolate a corollary of that question is, if I have 100 rupees, how would you recommend I invest across CCP, Rising Giants, KCP, and if I'm lucky, LCP?
Right. So if you sort of take the risk return trade-offs here, CCP returns now. CCP is a 3-year-old product. It's compounding at 25-26%. Assume in steady state that a CCP will be a 20-25% type compounding portfolio. There's beyond the live running of the portfolio that we've seen, there's 20 years of back testing to suggest 20-25% from CCP will be very doable. The volatility of a CCP is akin to a 10-year Government of India bond. It's roughly half as volatile as the Nifty. Little Champs, which Ashvin looks after, is now 2.5 years old. It's 2.5 years old. It's compounding at, say, the mid-40s mark. Assume in a steady state scenario that Little Champs should be gunning out 35%. When we marketed Little Champs for that 6-7 month period, our expectation was mid-30s compounding. The fact that it's done mid-40s is good, but I think in steady state you should think about mid-30s compounding. That's the sort of free cash flow growth the Little Champs companies are showing, and therefore my reckoning is Little Champs in steady state will be a mid-30s compounder. Volatility in Little Champs is similar to that of the Nifty. So CCP half as volatile as the Nifty. Little Champs similar volatility to the Nifty. CCP 20-25%, and Little Champ is giving 35%. Right? Rising Giants sits somewhere in the middle of these two portfolios, not just in market cap but also in the risk return trade-offs. I would say Rising Giants returns will be between that 25 to 30% mark. The free cash flow column here, as the economic recovery kicks in, I expect to see that free cash flow column tick towards the 30% mark, and therefore Rising Giants return should be between the 25 to 30% mark. Volatility of Rising Giants should be akin to the Nifty. So if you had 100 rupees to allocate, to Marcellus, I would suggest 50 rupees to CCP, 10 to 20 rupees to Little Champs, and then around 30 rupees to a portfolio like Rising Giants.
Fair enough. There are a few clarifications I'd like to give some of the questions. Some of what we said might have confused you. So when we said STP, you still need to invest the entire 1 crore upfront. We will plug in only 20 lakhs of that in the underlying portfolio, and 80 lakhs will be kept in a liquid fund. And every month on a prefixed date, 20 lakhs will be redeemed from the liquid fund and invested in the underlying portfolio. It's not like you can invest 20 lakhs a month. You'll have to give us the entire 1 crore or whatever amount you want to invest at the get-go, a minimum of 1 crore. There's also a question mark around why the fees is higher on a like-for-like perspective. For example, if you take fixed fee, the fee is 50 bips higher in Rising Giants as compared to consistent compounders. Now, there are two ways of looking at it. The supply side, which is from our perspective, the manager. Consistent compounders, as Saurabh mentioned, has an average market cap of about $20-25 billion, whereas the Rising Giants is most likely going to be around $3 to $4 billion. Naturally, the max fund size we can go up to before we hit capacity constraints is significantly higher for consistent compounders as compared to Rising Giants, and therefore, by definition, the max fee pool we can generate is also commensurately lower for Rising Giants. However, the sort of research we do is no different for Rising Giants as compared to consistent compounders. Arguably, it takes us a little more extra effort in researching mid-cap companies versus the well-known CCP. And therefore, from our perspective, a higher fee is justified. From your perspective, on the demand side, clearly, Saurabh mentioned how you should look at expected returns from Rising Giants versus CCP. And to that extent, on a net of fees basis, despite the higher fees in RG, you should look to expect higher net of fees returns. So that's why both the parties sort of justify that fee. Somebody's asked a question around why don't we have I think they said benchmark, but I think they meant hurdle. Rather than having a fixed hurdle, have the benchmark or a Nifty as the hurdle. In fact, that's an innovation that we've launched it in this strategy. None of our other strategies we've had. So when you get the fee structure, you'll see that the hybrid option, the one with the performance fees, has a two-layered profit share mechanism. The first layer of profit share is on an absolute performance. At the end of the day, we can't be charging you fees for delivering alpha while the absolute performance has been paltry. Take, for example, the year ending March 2020, when the Nifty was down 25%, our CCP was up 8%, yet we did not charge any fees because ultimately all of us can only eat absolute performance. We can't eat alpha like they say. However, we do understand the sentiment, and we've broken down the profit share into two elements. We've had one level of profit share at 10% above the hurdle of 6%, and also an additional 5% if we beat the benchmark. Only on the portion of returns that is higher than the benchmark, we take a 5%. That way, we're also incentivized to deliver relative return as well. One of you has asked a question around why the entire portfolio hasn't been disclosed. I guess if you recollect, even with Little Champs, until unless the entire funds were deployed, we did not disclose the portfolio because Little Champs and in some ways Rising Giants as well have a little bit of a constraint around liquidity. So therefore, a mass disclosure of a portfolio has its own impact in terms of price impact when we deploy our clients' funds and can eat into the potential returns that our clients can get, and hence the masking of names in the portfolio as well. Saurabh, any sense on LTTS versus Tata Elxsi?
So both are good businesses. Tata Elxsi is specifically focused on product design. LTTS does more than product design. LTTS also streamlines, say, for example, manufacturing processes, production processes inside factories. So Tata Elxsi is a more narrowly focused niche franchise, good franchise, but we wanted something which has more breadth across the engineering R&D space, and LTTS therefore gives us that. I think also billing rates are higher for LTTS. The day billing rate is higher for LTTS than Tata LIC, significantly higher, if my memory serves me right. Day billing rates are higher, and that's because LTTS is able to span a broad swathe of industries where there's massive shortages in the West on engineering R&D.
Right. So I guess several people have asked the question that sort of when you gave the allocation, you missed how does KCP fit in there?
KCP and RG will have similar risk return profiles. Both are 25 to 30% type compounders. In fact, KCP I think is compounding in that 25 to 30% space. RG will be, as I said, RG, the free cash flow numbers I expect to see tick up over the next 4 or 5 years. So both have similar risk return profiles, which is riskier than CCP, less risky than LCP, higher returns than CCP, lower returns than LCP.
Right. Fair enough.
To promote this on that point, I think just one point worth addressing. So folks, a lot of you, will sort of think that let me invest with another Marcellus portfolio. We'll obviously be happy to have your business. But one thing just to keep in mind that if you are investing in RG because you like the construct, you like this sort of portfolio, and you want to lock into good compounding engine which has significantly higher than the market returns with comparable volatility as the market, we'd obviously love to have your money. But if you're saying I'll lock into RG because I'll get another bunch of stocks and that will diversify my risk, I think that's a sort of thinking you should revisit. One of the things we've seen with most wealthy families in our country is they spray their wealth across too many portfolios, whether it's mutual funds, PMSs, their own personal PA investing. And one of the points we keep telling people is concentrate your investments on 2 to 3 really high quality portfolios. And we would stick to that point of view. Invest in RG if you buy into the construct that the country is consolidating, the economy is consolidating, a handful of companies are scooping the profits in every sector. No more than 2 to 3 companies are typically taking away 80-90% of the profits in every sector. And invest in rising giants if you want to ride that paradigm in the context of mid-cap India. Don't invest because it's yet another portfolio. I'll invest in another 15 stocks and therefore that'll spread my risk. More stocks, adding lots of stocks to your portfolio doesn't necessarily improve your returns relative to your risk.
There's a question around the Relaxo exit. Obviously, we won't comment if it's there in Rising Giants or not, but some of them have asked because Relaxo meets most of our characteristics around free cash flow generation. Why have we exited in CCP? I think we've answered in the CCP webinar, but just
and in the CCP newsletter, I think the rationale was clearly laid out that TCS got a better score on the longevity framework than Relaxo, edging out Relaxo from the CCP portfolio. And as has been said, we continue to hold Relaxo in several of our portfolios.
Yeah, I think that answer and the previous answer Saurabh gave also answers another question around people asking how many stocks are overlapping between CCP and LCP. I think in some ways it's all related. The reason Relaxo exited CCP was more from a fit into that portfolio's unique risk and return expectations, right? Consistent compounders by definition is consistent in longevity. It doesn't mean that it can't fit into any other portfolio. And also by now that we prefer concentrated portfolios rather than adding TCS as yet another stock in the portfolio. We thought we'll retain the concentration, and hence something had to make way. And hence Relaxo. Another fund like a Rising Giants or a Little Champs has a completely different risk return combination to offer, and therefore those stocks might make it in. And therefore that also answers the question. We wouldn't recommend you start looking at finding new stocks to be discovered in Rising Giants. We don't look at it that way. We've created a market cap spectrum as the potential investable universe for this at $500 million to $10 billion market cap. Our only intention is to build the best possible portfolio in that market cap spectrum. We don't really look at whether it's there in CCP or LCP. If it so happens, it's natural because some of those stocks will have in-depth research from our end. But we can't really tell you, for example, there will be quite a few investors who will be investing only in rising giants. And we can't tell them, sorry, we have these stocks in CCP and LCP, and hence we can't have that for you. Our intention is each of these funds are independent by themselves, and each of them demonstrate a different combination of risk and return, as sort of outlined. It's up to you and your wealth manager to figure out what combination of these funds is suitable for you. Our job is to deliver the best possible risk-adjusted return in that strategy. There's a question around profit concentration. I'll just try and frame it in a more constructive way so that we can take away something from that question. Obviously, somebody's pulled out the FY21 numbers and shown that the top 20's concentration has come down to 53%. Naturally, FY21 has been a spectacular year for a number of commodity companies, so on, which hitherto did not deliver profits for a long period of time. So that's, I guess, missing the big picture. But more importantly, I think the relevant question is around, so we have only 2 of the top 20 profit generators in HDFC Bank and TCS. We don't have any of the other 18. I think worth highlighting how we're looking at consolidation in industry after industry. That at the economy level is perhaps the big picture story that gets replicated industry after industry, and why we should combine the two. Saurabh, if you can articulate, I'm sure you can do better.
Firstly, on that profit concentration point, in all our studies, when we look at top 20 profits, the numerator is top 20. The denominator is the top 20,000 companies in the country, right? So you can buy databases like ACE, or if you go to the Government of India, the Ministry of Corporate Affairs website, you can figure out the top 20,000 companies' profitability. So my memory serves me right. Even on even as recently as FY20, the pre-COVID year, with top 20 in the numerator and top 20,000 companies in the country in the denominator, the profit concentration was pushing 80%. And as other companies, as the rest of the economy files this year's numbers, because remember, smaller companies haven't yet filed their numbers with the Ministry of Corporate Affairs for FY21. We'll see what the ratio is. I'll be astonished if once smaller companies, not just listed companies, once the 20,000 companies in India who have net worth above 10 crores, once they filed, I'll be astonished if the profit concentration goes significantly below the 80% mark. So that's the first point. Now, our job is not just to buy the top 20 in terms of profit concentration. Our job is to buy, remember, free cash flow concentration. So I think in our February blog, we had published the list of the franchises which have grown market cap and free cash flow the fastest in the last decade or so, right? And that list, if you look at that list, the top 20 compounders in terms of free cash flows and market cap over the last decade or so, several sit inside our portfolio, such as a Bajaj Finance, such as an Asian Paints, and that in a way captures the essence of our job, right? A top 20 company by way of profits, I think, includes Coal India. But is a Coal India a natural fit for the Marcellus portfolio? Is it a Steel Authority of India or a State Bank of India a natural fit in a Marcellus portfolio, even though they make it to the top 20 on PAT, given our framework of high quality compounders, dominant franchises? Many of the PSUs who make it to the top 20 PAT list struggle to make it to the Marcellus portfolio. However, a significantly higher number of top 20 free cash flow growth stories and top 20 share price compounding stories over the last 10 years, a significantly higher number make it to the Marcellus portfolio, Marcellus CCP portfolio. We're referring here to the CCP. Given that the CCP also contains smaller companies, naturally, not the entire CCP is from the top 20 free cash flow generators. So you've got a decent number of top 20 free cash flow generators. By the way, if anybody had invested in the top 20 free cash flow generators, if anybody was God, and in 2010 they knew who would be the top 20 free cash flow generators, had you invested in them, you would have compounded at the 25-26% number. But unfortunately, back in 2010, we didn't know who would be the fastest free cash flow growers in the last 10 years. So with our human skills, we have locked into franchises like a Bajaj Finance, like a Asian Paints, like a Kotak Bank, which have made it to the list of the most rapid compounders over the last decade or so. And therefore, our view remains that if you take CCP today, that's our view on who are the companies who will dominate free cash flow generation at the country-wide level over the next 10 years. The profit compounding is a fact of life. It's not something we've created. It's a fact of life driven by those trends that we discussed at the beginning of the presentation, which is you've got exigency after exigency crushing small companies. That's handing over the sector to not just say large cap companies like Asian Paints or Titan. It's also handing over niche sectors of the country like Path Labs to the company whose name we can see on the screen, like say the undergarment sector to the company whose name we can see on the screen. And that's something we are profiting on from in large cap through CCP, in mid cap through Rising Giants, in small cap through Little Champs. Right. So if you add the three portfolios up, roughly you've got 30 stocks. And they're giving us the best chance to profit from this incredibly polarized paradigm in our country. And unless some miracle transpires, this polarization is only going to increase. It's not going to reduce.
Right. I think that's an important point because an automatic takeaway would be large caps are going to win. That's exactly not the case. Even some of our little champs companies are market leaders, dominant market leaders in their respective sectors. So this theme of consolidation is playing sector across sector. Just because a company is small cap doesn't mean that it's a consolidator. And our theme or our attempt is to play across market cap spectrums. This bout of consolidation.
And Pramod, just to sort of elaborate on that, folks, I'm sure many of you have come across indices or tracker funds, which are built on fundamental factors, not rather than market cap, right? Fundamental factors. So if today you take India's top 20 PAT generators and you build a portfolio around them, right? It's not necessarily that will beat the CCP because India's top 20 PAT generators include several PSUs who are giant in terms of their PAT, but their fixed assets are also gigantic, and their return on capital employed therefore is below the cost of capital. So these top 20 PAT generators, they are giant companies. They have pride of place in terms of PAT, but because return on capital is below cost of capital, a CCP will in all likelihood outgun them. And many of the CCP constituents over the next 10 years will enter the top 20 PAT generators. In the last 10 years, for example, Kotak 10 years ago was nowhere in the top 20 PAT list. Kotak now has entered the top 20 PAT generator list. 20 years ago, an HDFC Bank was nowhere in the top 20 PAT list. Now, HDFC Bank, I think, is number 2 on the PAT generation list. So in the PAT generation list, the top 20 PAT list, roughly half the names were in the top 20 PAT list will go out. What we are trying to do in CCP is capture the next generation of companies. 10 new companies will enter the top 20 PAT list. It's important for us, it's important for you that the CCP contains the next wave of companies who over the next decade will enter the top 20 PAT list, right? Because half the current incumbents in top 20 will exit, and we are backing many of the CCP companies to make an entrance into the top 20 PAT list.
Enough. I think we've answered most questions around the philosophy. There are a few housekeeping points I think I should reiterate because some people might have joined late. So the minimum investment is 1 crore, irrespective of how much you already have invested in Marcellus. Even to avail of the STP plan, you need to invest a minimum of 1 crore, which then can be deployed in a staggered fashion at 20 lakhs per month. There's also an SIP available after your minimum investment of 1 crore. You can then do an SIP of 2 lakhs a month. There's also an ad hoc top-up facility available. You can top up at 5 lakhs a month. And you asked about taxation. Taxation in a PMS is straightforward. It's pretty much akin to investing in your direct demat account yourself. So we'll help you. At the end of the year, you will get a statement from us in terms of total dividends received in the stocks in your portfolio, which are subject to tax as well, and the total capital gains, whether short-term or long-term. Again, all of this will be audited, and therefore make it easy for you or your CA to file your returns on your behalf. The timing of inflows here, however, unlike some of our other funds, will be staggered. We won't take funds sort of perennially. We will be taking funds pretty much roughly on a quarterly basis. Currently, it is open till 30th December. We need the funds in our bank account by 30th December, which means that you need to have opened the demat account much before that. For existing investors, you don't need to open an additional demat account. The process is fairly simple. You just need to sign on the Rising Giants investment approach, and that can be done fairly quickly. But given it's holiday season and we expect a little bit of a rush towards the end of December, if you're keen, I would recommend getting in touch with the Marcellus salesperson as soon as possible. With that, I'd like to bring this call to an end. Thank you so much. It's always a pleasure taking questions. Thank you, Ashvin and Saurabh. Looking forward to seeing many of you participate in the Rising Giants PMS.
Thank you. Thanks, folks.
Thank you. Thank you very much.